The incredible business model of Visa and Mastercard. Payment networks are among the most advanced business models, yet they are often not fully understood. In this video, we will explore the business models of the world's largest payment networks, Visa and Mastercard. We will delve into their growth, fundamentals, and potential risks. Digitalization in the financial sector is extremely important today. Many banks are working on improving their digital tools, particularly in the area of payments. The two giants in the industry, Visa and Mastercard, have also noticed this trend. For years, they have been experiencing double-digit growth in revenue, profit, and cash flow. Since 2016, the stock prices of both companies have at least doubled. The future looks promising as well, with expected double-digit growth over the next 2 years. Visa is the world's largest payment processor, handling nearly $15 trillion in transactions in fiscal year 2023. Operating in over 200 countries and processing transactions in more than 160 currencies, Visa's systems can handle over 65,000 transactions per second. Mastercard, the second largest processor, handled over $9 trillion in transactions in 2023, operating in over 200 countries and processing transactions in more than 150 currencies. Together, Visa and Mastercard control 87% of global network card brands in the U.S. To truly understand the power of Visa and Mastercard's business models, it's important to note their revenue sources and how the value chain works regarding payment processing. They do not issue cards themselves or set interest rates. Instead, they provide networks for electronic payments involving merchants, banks, and consumers. Their revenues stem from transaction processing fees and services offered to financial institutions. One of the most misunderstood aspects of Visa and Mastercard is that they do not hold the debt on their cards or collect money from the interest on that debt. Visa and Mastercard are not credit card companies. They don't issue credit cards, nor do they make money based on how much you spend on interest on your credit card. None of that is part of their business model. Banks are the ones that issue credit cards. When you get a credit card or debit card, you go to a bank, sign up for it, and they are the ones who give you the card. When a bank decides to issue a credit card, they need to choose a network that connects customers and merchants back to the bank. Without a network, how would they connect with every other merchant worldwide? They must decide upon a network, and naturally they want to use the one that is the most proven, has the best protections, the best reputation, the most uptime, and of course the largest network. They want to have access to as many merchants and customers as possible. So they typically go with one of the big players, Visa or Mastercard. These are the most ubiquitous, most used, most regulated, most protected, most insured, and best reputed networks. The bank chooses to go with them, signs up for their network, and all Visa and Mastercard do is link together the merchants, customers, and the bank. They connect these three different parties in a payment processing network. That's all the company does. People often think that Visa and Mastercard charge a lot of money. Actually, they don't charge customers a lot at all. In fact, they charge a tiny percentage on the payment amount processed. On a typical $100 purchase, they might only take 14 cents, which is a tiny fraction of the actual purchase. The majority of the money made here is from the banks themselves. Unlike Visa and Mastercard, the banks are the ones extending credit and actually giving you a loan. When they do this, they make money from people paying interest on these credit cards. But that interest goes back to the bank. Visa and Mastercard don't see any of that interest. If we lived in a world where Visa and Mastercard didn't exist, banks would have to make direct connections to every single merchant and customer themselves, which would be more cumbersome and ultimately more expensive for the customers than having Visa and Mastercard specialize in it. A way to describe payment processing is as a digital counterpart to railroads. Just as goods cannot be transported by train without railroads, giving railroad owners significant control over transportation, so too do payment processors control digital transactions. If a new entity were to start building railroads, the costs would be prohibitive. Initial investments would yield little return, as a single railroad in, for example, Texas, would offer limited value if not connected to a broader network across America. The same applies to payment processing. Network effects describe a phenomenon where a product or service becomes more valuable as its user base grows. This concept is essential in understanding the dynamics of many businesses and technologies, especially in the digital age, and is particularly relevant to the Visa-Mastercard duopoly. Essentially, as Visa or Mastercard adds another bank to its payment network, its value to merchants increases, and the same is true in reverse. This creates a virtuous cycle, making Visa and Mastercard increasingly difficult to compete with as they expand. So to put it simply, every time you purchase something and you see a Mastercard or Visa logo, whether it's through Apple Pay, digital, crypto-linked, or online, the merchant pays a tiny percentage of the amount to Visa or Mastercard for processing the purchase on their network. This may make you wonder which of the two is actually the best investment. While there are various reasons why you might pick one over the other, it does not really matter, because the majority of payments in the world are still done in cash. Cash is the largest competitor in terms of the number of processed transactions globally for Visa and Mastercard. Even in well-established countries like Germany, 63% of transactions are still done in cash. In Portugal, it's 64%, and in Spain, it's 66%. As we progress towards a world where digitalized payments are more convenient, there is significant room for growth in digital payment networks. The digital payment industry is expected to grow from $2.45 trillion in 2024 to $4.78 trillion in 2029, representing a compound annual growth rate of 10.88%. The largest growth is expected to be in the Asia-Pacific region, in countries like India, Indonesia, and China. The credit card market in India, for example, is experiencing significant growth. The number of credit cards in circulation grew by 13.5% to 101 million in 2024, with a compound annual growth rate of 12% over the last 4 years. The total number of digital transactions in India reached 114 billion in the financial year 2023, and it is projected to reach 2 trillion by 2025-2026. Not only will there be growth in the number of digital payments processed, but also in the value of these payments. As populations develop and become more prosperous, their spending will increase as they can afford more luxuries. The growth is particularly prominent in emerging markets where economies are developing rapidly, but even in the developed world, there is noticeable expenditure growth. Additionally, inflation plays a role. Inflation is the phenomenon that makes prices of goods and services more expensive, typically targeted at around 2% by central banks like the Federal Reserve and the European Central Bank. Remember that Visa and Mastercard charge a percentage of the payment amount being processed. As the value of transactions increases, so does the amount they receive, providing them with a unique hedge against inflation in their business models. Inflation is not a foe to them, it is their friend. These business models have not gone unnoticed by super investors. Let's have a listen to what super investor Bill Ackman has to say about them.
I'm looking at MasterCard before it went public, and I've always believed that, I'd said previously, I was asked by, at a business school by a student, what's the single best business in the world? And I said, if you could own a royalty on people spending money, like Visa or MasterCard, it's the greatest business in the world. And if that ever became a public company, you want to buy that company, or if you ever could buy that company.
Bill Ackman ended up not buying the company as he couldn't get comfortable with the regulatory risks involved, missing out on tremendous gains. The power of Visa and MasterCard's business models is really shown in their fundamentals. For example, software companies like Microsoft are known for their high gross profit margins, around 65 to 70%. In contrast, MasterCard's gross profit margins are 75 to 80%, and Visa's are around 80%. Meta is known for its high operating profit margins, up to 35 to 40%. In comparison, MasterCard's are 55 to 60%, and Visa's are 65 to 70%. Apple is known for its high return on equity, selling iPhones at premium prices, leading to an ROE of 150%. Interestingly, MasterCard's ROE is about the same. When you get these kinds of numbers, it will attract a lot of competition willing to eat into your market share. MasterCard and Visa, with their large base of users and merchants, find themselves in a secure position. Competition comes from American Express and Discover. Consequently, American Express, arguably their closest competitor, has been forced to expand its payment network in alternative ways. These include offering loyalty points, with the hope that increasing its user base will encourage more merchants to accept its card. But these are not the only risks involved. Due to the oligopolistic nature of the industry, regulators closely scrutinize Visa and MasterCard, and they are frequently subject to lawsuits. Both companies have had to pay substantial fines in the past. Although the current positions of Visa and MasterCard are firmly established, the electronic payment infrastructure continues to develop in ways that could impact their volume or profitability. Some governments prefer local payment networks. As a result, Visa and MasterCard may be pushed out of certain markets, preventing the companies from fully leveraging the value of their global networks. UnionPay, China's local payment network, is a good example of how governments can favor local networks. This could result in lost opportunities for Visa or Mastercard in certain emerging markets. Data security is seen as the company's biggest risk in terms of environmental, social, and governance factors. Every processor of payment transactions is exposed to the risk of system breaches. However, we personally don't see a large risk to the business model of Visa or Mastercard. Only a significant change in payment networks, such as the widespread adoption of Bitcoin or other cryptocurrencies, could have an impact. However, these have been around for more than 10 years and have yet to gain widespread acceptance. Moreover, governments would likely never allow it. If you enjoy these kinds of videos and are eager to learn more about business models, visit WIC Academy and try out our investment training. We dive deeper into businesses, their valuation, management qualities, and more. Click on the first link in the description to start for free today and see if it's something you like. Thank you for now. Leave a like and subscribe to the channel for more.